Hi, I'm Tom Stevenson and welcome to Construction Business Management. In this module, we're going to be introducing you to the balance sheet. This is part of the Construction Business Management course. If this is the first video that you're seeing on this, I would encourage you to take a look at the description below, and I've included a bunch of links to previous videos. As well, you can click subscribe to my YouTube channel and you'll see under the playlist Construction Business Management the other listings in this particular series. But today, as I mentioned, we're going to be talking about the balance sheet and what it means if you're starting a construction business or you're running a construction business as part of the overall financial statements and as part of what you put together for a business plan. So we'll look at the key components of a balance sheet. We'll recognize how a balance sheet functions and what it really tells you that can be helpful for you to understand in very basic terms. We're not trying to make you an accountant here. We're trying to give you a good foundation so that as somebody that's owning and operating and running a construction business knows how to successfully manage the financial aspects in this part of the course. Overall, in the whole course, we're looking at all of the elements that come together in being successful in running a construction business. So the balance sheet consists of three main parts, and it is kind of like that scale that's shown, except the difference is it's always going to be balanced. It's always going to be balanced. And this actually, it's looking not, that image above me is looking not too bad as far as being balanced. So a balance sheet consists of assets, liabilities, owners or shareholders' equity. And a balance sheet, unlike an income statement, is taken at a point in time. I've mentioned a number of times the income statement is taken over a period of time, like how much income did we make? How much sales did we have last year? How much was our overhead for last year? How much was our direct job costs for last year? How much was our profit for last year? It's taken over a period of time. A balance sheet is at a point in time. So if the income statement was from January 1st to December 31st, the balance sheet would be on December 31st as an example, on that day. And it really is giving us a snapshot of the net worth of the business as of that day. It gives us a really good indication of that business and its net worth as of that day. It's kind of like the income statement is, you work for somebody and you've made X amount of dollars, $100,000 last year, right? So that would be your income. And then you'd have all your expenses. Well, okay, so I made $100,000, but I had to pay the rent. I had to pay, my Wi-Fi and my cell phone. I had to buy food. And you had all of these expenses, right? And whatever left, that would be profit in a business. And whatever's left, that would be savings if you're an individual, looking at it that way. Well, the balance sheet is looking at, well, what do I own and what do I owe? So what do I own and what do I owe? And if I have $2 million in assets and I have $1.5 million owing, it gives me an indication of the value. What's my value, net worth at that point? So that's what that is used for. And obviously, if you are a bank or somebody that's providing you with venture capital funding or financing for your business, I kind of want to know how you're doing, right? I want to know if you're up to your eyeballs in debt. I want to look at your income statement and I want to look at your balance sheet. One's showing me net worth. Another one is showing me your ability to earn an income and make a profit. And that's also giving me indicators as to whether this is a wise amount of money to provide you to operate your business or whether it's not a wise amount that as a bank or an investment institution that's providing funds, am I making good choices? So that's why they are after that information. So if we take a quick look at this example one here, we've got our assets, we've got our liabilities, we got our shareholders' equity. And they always have to balance. So it's not a matter of, oh, look at this, I've got more on my assets than I got on my liabilities. This is great. No, the way accounting principles work, GAAP. So basically, GAAP accounting principles work is they always have to balance. So the total assets that we have, and that's accounting current assets, long-term assets, as we'll talk about in a minute. Our total assets, $164,300. And there's all kinds of accounting rules that has to be formulated as to what you value things at in putting it into the balance sheet. Liabilities, you've got current liabilities, you've got long-term liabilities, you've got total liabilities. So if I add up this is $89,200. And what's left, shareholders' equity, is things like from the income statement, we made profit last year. Well, maybe we didn't pay out that profit. We kept it in the business to help the business grow. So that would be, well, if it was the most recent ones, as I said, if we're taking on December 31st, that would be our current earnings, so our current profit from the current year, and then previous years if we've added them up. Maybe we had 15,000 one year and 15,000 another year, so that would be our retained earnings. Like next year, we would then have next year's current earnings, and then this would be showing as 75,000 because it would take that 45,000 and add it to the 30,000, and then if we made a profit next year, then that would be showing here, the current earnings at that point in time. So this adds up to total shareholders' equity, and that's showing 75,100. So if I take 75,100 and I add 89,200, I should get 164,300. So this is the balancing side. You've got assets on one side and you've got liabilities and shareholders' equity on the other side. So think of those scales, those balancing scales that we mentioned, and they always need to balance. On one side, we've got assets. On the other side, we've got liabilities and shareholders' equity. And the truth of the matter is, when I did my MBA, I always, even when I did my undergraduate in business, I always had trouble sort of visualizing this part of it, but it makes a lot of sense. So the shareholders' equity, well, you put money into this business, right? So whatever money you put into this money or profit that you kept in this business, this is money that's owing to you, right? So it's a liability to the business. It's not a liability to you if you own it, but it's a liability to the business. So this is our liabilities, our loans, but it's also the money that we put in or the money that we earn that's owing out to us. So at some point, if we want to close down the business, we want to take this money out. That's what that is. And so that's why that has to equal our assets. And obviously, if something has been overvalued here, there might not be the money in there, and that has to be reconciled. So it has to balance. It has to balance. The only way it doesn't balance is if you've made a mistake. That's your indicator. If it's something's wrong, it's not, oh, this is great. No. One side has to equal the other side. That's a basic fundamental accounting rule. And so we think about it in those terms. Now, assets and liabilities, they're divided into short and long-term obligations. So you have current, that would be short, that's 1 year or less, and that's longer, all right? So they're always into like short-term or long-term. And they're actually listed in a certain way when you get into accounting aspects, like cash is worth a lot more than accounts receivable. Why do you think that is? Well, accounts receivable, you know what? A bird in the hand is worth two in the bush. So I've got $500,000 in accounts receivable. Maybe there's somebody that's not going to pay me. It's an account receivable. I did the work, but if they don't pay me, I don't get it. If I don't get it, it's not going to come through. So accounts receivable is work that we've invoiced for and we're just waiting to get paid for. Work in progress is work that we've been doing, but we haven't yet invoiced for it. So balance sheet really attempts to find out where you're at that moment in time, right? If it's midnight on December 31st, 2019, it tries to really get to what that is. So it includes work in progress, it includes accounts receivable, and it includes cash. Now, cash is king because it's got the most liquidity. If I got to pay a bill, this tells me something. So again, if you've got a loans department or you're working with a bank to increase your line of credit because you got big projects, construction projects coming up, one of the things that you would, what I would be looking at if I'm the bank is, well, how much liquidity do they have? You know, even if you have some long-term assets, like you own the building that your office is in, that's good. I would think of that as a positive, but I'd be kind of concerned if you have like very, very little liquidity cash, right? So I look at those types of things. There's a bunch of factors, not one, but that's one of them. There could be other things that temper that. Liabilities, all right, so what other amounts do we have owing to the banks? And of course, if we're counting accounts receivable, well, we got to count accounts payable, which is, well, what do we owe? Like to suppliers, to people that we have, that we owe money to, the suppliers, subcontractors, trade partners, etc. So we have to account for that as well. And that's in the more short term, that's 1 year or less. On the longer term, equipment loan, shareholder loan, because maybe this bank loan is due in a short period of time. If it's like a mortgage or something, it would be over here. So that's total liabilities. And again, it's just basically this has to equal that plus that. So assets and liabilities are divided into the short-term and long-term, current or long-term. And it really sort of looks at the urgency from that perspective. And assets are defined, as I mentioned, like things like cash, the types of cash, government securities, how convertible something is into cash, electronic cash, that's fine. Like digitally, it doesn't have to be obviously cash, but if we've got it, that it's in a bank account that we can easily move it around, that's what we need, right? And so when I say cash, that's what I'm really meaning is like in a bank account that it's easy to pay a bill electronically, very smooth that way. If it's a truck, it's not got the same kind of value attached to it. And then again, as I said, GAAP, generally accepted accounting practices or principles that must be followed in following your accountant follows in filling out your income, balance sheets, cash flow, etc. There's a process there. And if it's a publicly traded company, it's a very, very rigid, tightly reviewed process to make sure that what's being represented to the public who may be buying shares of your company is representative of what's going on in the business. So when we look at that, and also there's that side, then there's also the side of financial statements that your government tax agency would be reviewing and how they accept things. Because if you have like a truck, and the truck is 7 years old and you paid $35,000 7 years ago for this truck, you can't put that it's now worth $35,000. It's depreciated. It's a wearing asset because every kilometer, every mile you put on that truck, it's wearing out. So there's a depreciation method that has to be followed when you get into the details of accounting. So it's not you willy-nilly just saying, oh, I paid $35,000. That was 7 years ago. It might only be worth $4,000 now. So you have to look at what the requirements are for that. So the balance sheet should be representative of things in that nature. Even things like like properties are also shown on the balance sheet. What's interesting about properties is, according to GAAP, is you put the amount that you paid for the property. So if I bought this property that I plan to develop a house on 10 years ago, and I paid $1 million for it, and now it's worth $3 million, I put $1 million. They have certain rules around that because they know that people, if they didn't have rules around that, they would inflate the value of the property. So what happens when a bank's reviewing that? It might show on the balance sheet as basically the book value of what you paid for it in a case like that, because land's not depreciating. It's not going to nothing. If anything, it's appreciating, right? Generally speaking, unless you have some sort of abnormal dip in the marketplace. Well, if it has gone up in value and you've got a lot of property listed on your balance sheet, you would want to outline that. Basically, whoever's loaning your money would want to look at, well, what is that property really worth? So you might even have to get a property assessment to say, well, it shows on the balance sheet $1 million, but look, here's what the assessment is. Here's the comparables. This is $3 million. And then that obviously would have an influence on how the review process would go for that. So there's certain things we have to follow, and then there's certain things we know as far as, reviewing balance sheets that we have to look in more detail, like bankers would know that, investment capitalists would know that, etc. That they'd want to look at, oh, you've got some properties here. Have you got a recent assessment on those properties? And we can better evaluate that, because that would make a difference. It was once said with McDonald's that McDonald's, if they took the current value of their properties, just looking at their balance sheet is one thing, but you'd want to definitely look at the current value of their properties when they own all the properties that the restaurants were on, which was prime locations. It's like a humongous amount of money compared to, because some of those McDonald's, they've been sitting on those properties for 30, 40 years, 50 years. You can only imagine what they're worth today compared to what they would have paid for them way back when. So that kind of thing you've got to think about in those terms, right, with the balance sheet. And as I said, GAAP has a whole bunch of accepted accounting principles that must be practiced. And when you hire a really good accountant, they know exactly how those principles are, and they can help you with those aspects and better determining what's going on with your business in those ways. Other examples, like I said, cash, it's usually placed in the order of liquidity, how easy something is moved from cash to cash, and cash being king. And then you've got the long-term assets, some examples like that, if you own the building or things of that nature. And in construction, let's face it, that becomes a big one depending on the type of business that we're running. If we're building custom homes and that sort of thing, well, what are the assets? What are the properties that we have? We may not be necessarily turning that house over within the next 12 months, but we might be turning it over in the next 2-3 years. And liabilities, what we owe, and accounts payable, and short-term or long-term obligations. Again, how that's reviewed from those perspectives. Short-term liabilities also could be a credit card, as an example. If we have a credit debt, and everybody's using credit in a variety of ways, those would be things that would be looked at and reviewed. And current compared to long-term. 1 year compared to more than 1 year. And that's where you get into the differences and how it's reviewed and how it's looked at. Owner's equity. The other element of the balance sheet that we look at is, as I said, this is, what money did the owner put into the business to start the business? What income, profit has it kept in the previous years in the business to make the business thrive and grow and scale? All of those things, that builds into owner's equity. What the balance sheet does not include is the goodwill of the business. Goodwill of the business. And that, if you're trying to sell the business, definitely the balance sheet is reviewed, but the goodwill of the business is also the brand of the business. In construction, some construction businesses, they're small and it's all about, if it's Tom Stevenson specifically doing something, it's hard to sell that business. But if you've grown it and it's actually representative of a whole area of work, not so much just the name, but what the business represents, and whether you're there or not, it's become this entity that can run itself and it can get its own jobs with proper management, obviously, then that has goodwill associated with it. You could think of the goodwill of, say, a business, the brand of a business. If you were to take an Ellis Don or a PCL or in the States, a Turner Construction or a Walsh Construction, has a lot of brand reputation, the types of projects that they've done, and their capabilities. There is a goodwill value to that. Outside of construction, probably one that you would just come to mind pretty easily would be maybe Apple, right? So there's a certain amount of, why do I have an Apple iPad instead of a Samsung iPad, right? There's a certain brand, because when I'm going to buy an iPad or a phone, I'm not thinking about, oh, I wonder what Samsung's done. There's a certain brand that they've got this goodwill. They've got this following in that. I'm in their ecosystem, and that's got a value to it, but it won't show up on the balance sheet, is what I'm saying. So it's not just necessarily looking at owner's equity and saying, well, that's the value. No, there's a big difference there with that. But it does give us the hardcore value of the assets when we compare it to the liabilities and the owner's equity in the business. So it is giving us some valuable information that way, but it doesn't always tell the whole story. And I would say it tells less of a story when you talk about like tech companies and things like that, which can scale to such multiples. Construction businesses are a little bit more difficult that way. So the balance sheet actually holds a little bit more credence that way than, say, a high-tech business. The share value of publicly traded tech companies is very, very many multiples. Some would say too many multiples. But construction business, this is something that needs to be reviewed. But every business, a balance sheet is reviewed and looked at for those elements. And so when taken together, liabilities and owner's equity, that is what the business owes out. And it must balance with the assets of the business. So it clearly has to balance out. It's the owner's rights to the assets of the business. And as the figure increases, the owner's right to the assets of the business increase. Obviously, if it decreases the owner's equity, then the rights of the liability owners, the banks that own the mortgages on things, they increase. So there's that element within the liabilities and equity side of the balance sheet. All right. Now, that's, again, you got to kind of look at that too. You got to look at the type of business that you're in too. There can be a lot, and I'll do an example in a future video. There can be a lot when you look at leveraging. Especially say you build homes on speculation. So you're buying a property and you're buying homes on speculation. If you can get a fairly large loan on that, it dramatically increases your return on investment. So the fact that the balance sheet might show that you are fairly leveraged with liabilities, if you have a really good business plan that plays that out and explains that shows the high return on investment while mitigating and minimizing risk, that can be a good thing. So it kind of depends on the type of business that you're in. However, if you're a small renovation company and you've got all this money owing and you really don't have a really good strategy of why or how this happened or what's going on with this, or it's highly leveraged and your owner's equity is really down, and when we look at the owner's equity but your liabilities are really large, that's a flag. That would be a definite flag. So you have to look at the businesses, the type of businesses, whether the leveraging makes sense, whether it makes sense with the business plan. But there's a lot of flags that will go off depending on the type of business. And it varies in construction, as I said. So the options are many, as I said. Looking at the figures, if a small business owner wants to expand the business, the greater the amount of the owner's equity, the more likely the lending institution will be to grant additional funds. They want some skin in the games. And if they don't get it from the actual business itself, they'll probably want you to mortgage your house or some other assets that you have to be able to get that loan, or to get a cosigner or something of that nature. So the business banks do not like to lend money when they know that there's not moral hazard. Moral hazard means that, I'm a business owner. Oh, yeah, I'm just going to borrow it. Oh, I went bankrupt. That's okay. I borrowed it from the bank. Not my problem. Banks do not like that, right? Nobody likes that if you're giving somebody money. It's different. They feel that if you've got skin in the game, that you've got a lot of your own personal money in the game, then that's a different story. They feel, well, you're not going to want to walk away from that too easily, and it's going to hurt you if you do. So you're not going to want to lose that. And before you do, we would get the assets before you would. So that would be their logic in a lot of cases. And if you want to sell the business, the equity is the basis for the asking price of the business. It can be with that. So obviously, if there's a lot of equity in the business, that's showing that there's a lot of value in that particular business from that perspective. So how does owner's equity grow in value? What's the catalyst? Profit. If you keep the profit in the business, that's a big contributor to an increase in owner's equity. If every year you make this profit, it's like taking it out and you're spending it on yourself. So the business is probably maybe having trouble grow because you keep rating whatever profit it makes. And so then it's like starting from scratch and it's close to the line on it. So companies that reinvest in the business by retaining their profits in the business, or a good portion, it doesn't necessarily have to be all of it, can obviously grow the owner's equity. The more income you retain, the greater your owner's equity will become. And so an example of the links between the income statement and balance sheet. Income statement, that shows us what our profit is. So that's the link between the income statement and the balance sheet, right? That information, that profit is there. That's building up in the balance sheet. And that's linking it to there. It's also the income statement, the cash in the balance sheet is actually linking to what we'll talk about coming up. The cash flow, all right? How much cash do we have in the bank at this point in time, right? Those things play into that. So they are interconnected, the different statements. Owner's equity can only remain in the business if it is a corporation. Now that's the other thing. We talked about at the very beginning, we talked about the different types of businesses. You could have a sole proprietorship, the very beginning of the course, not this lecture here, but you could have a sole proprietorship. I think that was the second lecture or the first lecture. Sole proprietorship, well, the business is you, and you file a tax return, and because it's you, you have to pay tax every year on it. So you pay it as a personal tax. If you're a corporation, the money that the corporation earns, it's treated as a separate entity. So that business then pays a corporate tax, and they pay a smaller corporate tax. Depends on what the government rates are, but it pays a much smaller corporate tax. So you could keep that, you could pay the corporate tax, you'd have to pay that, and you keep the money in the business, but you'd have more money of it than if you were an individual because you pay a higher corporate tax, and help that money to increase the business. If I'm a developer, I could help that money to leverage to buy more properties, as an example. Or I could buy another vehicle and hire another person with that, and that would help me to take on an extra project. That would increase my sales. So I'll increase my overhead, but if I've worked it out, it could increase my profit proportionally or even more optimally. So all those elements pull together to really define how they work together. So that point that I'm trying to make there is there's some definite advantages to being a corporation. Otherwise, you are paying that money out every year, and you're not going to build the owner's equity into it that way because the owner is you. There is no other entity. That business doesn't pay out. You are it. But corporations that are built up that way, then you can retain that, and then that money can be better tax planning can be done with a corporation over the long term, especially if you plan on expanding the business to any kind of size that way. So there's a distinct advantage there from that perspective. So just when we're talking about, just remember that assets equals liabilities plus owner's equity. And of course, then you can do basic algebra to do any kind of difference that you want. Owner's equity minus assets equals liabilities, right? You can do any kind of manipulation there algebraically, and you can, it'll always work out. So it really helps the business to get a handle on the financial strength of the business. Should the business expand? Can the business handle the ebbs and flows of revenues and expenses? Should the business take steps to bolster cash reserves? It can be very helpful that way. So it's a good tool from that perspective. And you're going to see that there's a lot of ratios that we can utilize once we have the balance and income statements done that can help us to identify trends over time. As we mentioned in the previous video, Stein's law, a trend will continue until it stops. And we'll be able to look at is the receivable, how long is it taking for us to collect money? How long is it taking for us to pay money? Is this good or is this bad? And we will be looking at that in an upcoming module along with cash flow. I'll probably divide it up into 2 different video modules from that perspective. But it definitely gives us that information, and it's a very important tool to understand from a lender's, investors, vendors' points of view. Before I want to extend lines of credit, I may be requiring, as part of the business plan, the income, the balance sheet, and cash flow, and your projections on these areas, not only the current ones, but your projections going forward. And that can be useful for us, or as a lender or an investor, to determine, is this a good business or not to provide money for? And to be honest, if you haven't thought any of that stuff through, then I'm kind of nervous. If I'm giving you money, that just tells me you really haven't thought things through. I don't think I want to. You come back to me when you've thought it through. Right now, it's a no, but maybe if you really are able to sell it, because that's what you're doing in business. You're always selling. You're always negotiating. And this is also helping you with your vision. Where are we taking this business? With your mission, what are we about? What is this business about? With your core values that we talked about in earlier sessions. So as we go through this course, you're going to see these different areas of the business start to interconnect. And it's more than just exact dollars and exact science. It's just this ecosystem of your business. And if it's really weak in any one area, it's like, you've got an illness. It takes a business is very holistic process. Money is very important, but there's a lot of other parts of this business that are important. And if we don't do them well, then it will negatively impact the money, right? If we hire the wrong people, we're going to have problems with meeting our project projections and our estimates and that sort of thing. Then it's going to affect the business. If we don't market the business properly, we're going to have trouble gathering and retaining clients. It's going to affect the financial side. So there's this interconnectedness that's woven into running a business successfully. So I just leave this discussion question at the end for you. Probably not a bad, this is a good website actually to go to. I think if you want to read up more on balance sheets and get some good ideas exactly how that works in more detail, Investopedia is a really good site, I think, for people that are planning on starting or running a business or are involved with somebody else's business, to get answers to specific questions and to build up your research background in those particular areas. So I'm Tom Stevenson, wishing you a wonderful day. And if you want to find out more, check the descriptions below. Click the subscribe button, click the bell so that you can be notified of new updates. And if you go into my YouTube channel, check the playlist Construction Business Management, and that's where you'll find the whole series of these videos that you can watch in order and get the true sense of what it is. So I'm Tom Stevenson, wishing you a wonderful day, and I'll see you next time. Bye for now.